Good morning, everybody. Welcome to today's meeting of the Local Pension Committee. As usual, this meeting is being broadcast live to the public. For those not able to watch live, the webcast will be recorded and made available for viewing on the County Council website after the meeting. Today, we have most people joining us in the committee room, but we do still have some who are going to join the meeting virtually. Additionally, I received apologies from Nick Booth, Ashley Wilson and Mr. Gamble. For their benefit and for those watching on the website, can I please ask members firstly in the room to briefly introduce themselves. So I'll start with, if we could start with you, please, Ian. Work round.
Good morning, I'm Ian Howe. I'm the Pensions Manager for Leicestershire County Council.
Good morning, Chair. Keith Murray, County Councillor for Colville South Division.
Morning, Kevin Feltham, County Councillor for the Gartree Division.
Morning, Daniel Grimley, County Councillor for Birstall Division.
Tom Barclay, County Councillor for Tyson Ridgeway.
Kat Tui, Democratic Services Officer.
Hi, Bulesh Katra, Senior Finance Analyst.
Malleys Graham, Borough Councillor, Melton Borough Council, the Borough Council representative on the Pension Committee. Thank you.
Declan Keegan, Assistant Director of Finance. Chris Tambini, Director of Corporate Resources.
Thank you. I'll just go around the people who've got us joining online. So to begin, Claire Scott, if you could introduce yourself.
Hello everyone, I'm Claire Scott, I'm the Fund's Independent Advisor.
And Councillor Adam Clark, who's joined us online.
Good morning everybody, sorry I can't be with you in person. I'm Councillor Adam Clark, Deputy City Mayor with responsibility for the Environment and Transportation and City Councillor for Ayleston.
And Jackie Dean. Have we got Jackie Dean online?
Yeah, hi, I'm Jackie Dean. I'm the staff representative for Leicestershire County Council.
And we've got Stephen Tart as well. Stephen, if you can introduce yourself.
Morning everyone, my name's Stephen. I work alongside Tom at Hyman Robertson as Actuarial Advisor to the Leicestershire Pension Fund.
I don't know whether we've got Tom Hoare online as well, if you could introduce yourself.
Good morning everyone, Tom Hoare, I'm one of the fund actuaries at Hyman Robertson for the fund.
And Valborg Lai.
Good morning everyone, I'm Stewardship Manager at LGPS Central.
And we also have Zubair Limbarda. Is he online? If you could introduce yourself.
Yes, morning. I'm Zubair Limbarda, one of the members on the committee as one of the university representatives in Leicestershire.
Thank you very much. So I think that is everybody. So we will carry on. So the first item is minutes of the meeting held on the 10th of September 2021. I propose that the minutes of the meeting held on the 10th of September be taken as read, confirmed and signed. Is that agreed? Everybody in favour? Thank you, that's unanimous. Question time, we've received no questions. Questions asked by members under Standing Order 7.3 and 7.5. We've received no questions from members. To advise any items which are considered urgent, we have no urgent items. Does any member have any declaration of interest in respect of the items on the agenda to declare? No, there's nobody declaring any interest. So agenda item 6 is the 2022 Fund Valuation Assumption Report. So can I call on you, Ian, to introduce this report set out on pages 15 to 48. And we're also joined by Tom Hoare and Stephen Tart from Hymans, who have a presentation for this item. So over to you, Ian.
Thank you, Chair. I hope everybody can hear me. Is that okay online? Yeah, perfect. Yeah, good morning, everybody. Thank you, Chair. This is the report in regards to the fund valuation assumptions for the March 22 valuation. You may recall at the last committee meeting, I introduced the valuation and the concept of the valuation, and this is the first report that actually details some of the assumptions that we particularly need to work through. The key one today is the key assumption used for the investment returns, and the other assumptions we can come back to later. But just want to say before I start, we've got colleagues from Hyman's on the call as well. They've got a presentation that they can go through. In the interest of time, what I propose is I'll go through the report. You've seen the presentations attached, but if there's any questions, we can go through that at the end, and they'll happily go through that with any questions as well. Is that all right, Neil?
Yeah, that's absolutely fine.
Thank you. Okay, so the purpose of this report is to set out the assumptions in terms of how we wish to proceed for this valuation. I think what I would like to start by saying is the assumption last time when we had a valuation of March 19 for this particular area, we were in the process of working through the Mcleod Judgment. Just a little bit of history for those new members. The Mcleod Judgment was a legal challenge brought about by other funds, actually other public sector funds, to do with age discrimination, and that was to do with the move from the final salary scheme to career average. And when we were doing the 2019 valuation, there was a lot of uncertainty around Mcleod, and we built in additional level of prudence with the actuaries at 2019. And we used an 80% likelihood of achieving the future investment return. We are now a lot clearer in terms of Mcleod. The remedy, although it's not completely finalised, we're a lot clearer on the Mcleod costs, and they are a lot lower than we originally anticipated in 2019. So what we're doing is we're proposing we reduce that 80% likelihood of achieving the future investment return down to 75, which is what we would have had for the 2019 valuation had we known that the Mcleod Judgment ruling was clear at that point. Now, to avoid double counting for Mcleod, the proposal is to reduce it from 80% to 70%, 75% at the 2022 valuation. By doing so, this increases the future return assumption over the next 20 years from 3.8% to 4.1% based on the current strategic asset allocation and the current economic outlook at March 22. So the consequence of that is there's going to be a likelihood of an improved funding position within the fund. So what does that effectively mean to the sort of the employer contribution rates, because that's the key bit that the employers are particularly interested in. What we expect is by taking that reduction from 80% to 75%, the fund is going to be, the fund will be 100% funded, and that will obviously then filter through into employers' contribution rates. But as I mentioned at the last committee, the employer contribution rates are split into two between the primary and the secondary rate. And whilst we haven't got the final position yet until March 22, we expect there will be pressure on the future benefit accrual. So whilst it looks really, really promising in terms of a funding position, I think we just need to be careful that that doesn't necessarily filter through into reductions to employers' contributions. We still have to have a level of prudence, but we do also have to be fair to the employers. We have to have that balance. So what we're proposing, and this is early in the workings at the moment, but in section 15, we've laid out a table of what we'd propose to do with employers' funding levels, because we are aware that some employers will be over 100% funded. And whilst this isn't finalised yet, this is what we're sort of starting to work towards. And I won't go through each of those, but as you can see, the higher the potential funding for the employers, the more we can do to kind of bring that down to help the employers with their rates moving forward. The other assumptions, which we can't really kind of confirm yet because we haven't got all the necessary details, are detailed in section 16, which is the pensions increase, salary increases, longevity, and other demographics, things like commutation and ill health retirements. I wasn't going to propose to say a great deal more because I'm conscious Hymans are on the call and we've got the slides, but just to say we've laid out the timetable again, and as you can see that we're working through that timetable, and happy to take any questions at that point really.
Thanks very much. I think that's a very fair summary of the report. I will invite Tom Hoare and Stephen Tarp from Hymans. You've got a presentation on this item, so if you could continue with that, would be appreciated.
Yes, thank you, Chair. So the purpose of the sort of producing the slide deck today, we might not cover all the slides. I appreciate there's quite a lot of content, and obviously I can see it's quite a busy looking agenda. So we will keep an eye on time. We thought we would give the slide deck in full, so it's there in the pack, and you can reference back to it, and hopefully it helps to complement Ian's paper. And by all means, you know, I'd welcome any questions on it, on anything that any of the content that we've got in the slides or on Ian's paper. Obviously, today's a good forum to discuss anything that anyone's got in mind. But I think with that laid out, what we'll do is we'll cover some of the slides. I won't spend ages on some of them. Some of them are actually a bit of a recap from the presentation that myself and Richard gave to committee in September to sort of tee up some of the valuation discussions. And I'll try and pick out some of the key slides just to reiterate what Ian said and to complement his paper. And then we'll carve out a little bit of time at the end for Stephen's actually going to touch on some of the other assumptions that Ian mentioned or alluded to in his paper. Now, while we're not looking to make any agreement on the other assumptions today, it's useful for committee to understand what's down the track and what other assumptions do impact the valuation. So I won't labour this slide. This is some of you will be familiar with this from previous years. Why we do a funding valuation. It's obviously a key risk management tool. It's a key risk management exercise for the fund, and the assumptions is the tool to manage that risk. And as Ian touched upon, the assumptions, they are fund specific, but we do need to build in prudence. And what we do crucially is we build in that prudence exclusively to the future investment return assumption, which is what we're talking about today. All the other assumptions that we do at the valuation are best estimate. So while the committee might still get involved in some of those assumptions, there's less subjectivity because they're driving them towards being best estimate. A little bit of subjectivity and judgment comes in on the assumption that we're talking about today, the future investment return assumption. So that's why we can look at that early. The other assumptions will wait till March 2022 when the valuation actually officially starts, or that's the date of the valuation. But the future investment return assumption, it can be a principles-based discussion, which Ian's touched upon, this idea of the level of prudence. So moving on then, just a bit of a recap from last time. This is just in a kind of pictorial sense what a member's pension looks like, or one member in the pension fund. And the green bars are cash flows for that one member. Initially there's a large bar there, which would be their lump sum on retirement, and then the pension starts, and then they die in the future, and then a dependents pension would start. The reason this is important is just to show you that there's a whole host of assumptions that we need to make to be able to value or to place a value on those future cash flows, when they're going to retire, how much the lump sum will be, what pension increases will be in the future, what the dependents pension, how many people are married, all these different things that they feed into to that one member's future cash flows, and we boil that down to the liabilities when you look at it across the whole fund. So that's really important. Assumptions are really crucial to get them right. And a future investment return assumption underpins absolutely everything. All those future cash flows, all those future benefit projections that we're looking at, to bring them into today's money, we need to discount them, and sometimes referred to as the discount rate or the future investment return assumption. And that's why that's critical. It's the most important assumption, because it it carries through everything in the valuation. So just to reiterate that point, it's quite a useful table to refer back to. It's the key actuarial assumptions that we're going to be making at the valuation. The top one, as I've expressed there a moment ago, is the key one, this future investment return assumption. And there are other assumptions. The future inflation CPI assumption is a close second, because all the benefits are linked to, or broadly linked to, CPI. And then it's a sliding scale. Mortality is obviously important, and then maybe less so salary increases, and so on. So I'll talk a little bit about Mcleod and the future investment return assumption, but happy to take any questions if any of the members have any questions on the kind of broader spectrum of assumptions there.
Thank you. Thanks very much. Has any members got any questions? No questions. So we're now got. Is that the end of the presentation, Tom, or is Stephen going to do a presentation?
I'll, if it's okay, Chair, I'll dive into that. Was just a very quick summary of where we are. There is a few other slides. I won't labour them. I'll try and pick out some of the key bits to complement Ian's bit, but I will move on. I'm just mindful of inviting questions where possible.
Yeah, that's fine.
So this is just a picture to explain the point Ian made about the Mcleod underpin, and this is why it's crucial to the decision that we're making today. That this idea that there was an allowance, a margin built in for this Mcleod underpin. It was a protection given to certain members, and we didn't know what the cost of that was going to be, so we had to build in a bit of a margin. So this is just something that you can sort of reference in your own time. But the crucial bit is that there's the bottom two bits on the right hand side. There's an underpin now provided to two groups of members. The grey members who were always entitled to this kind of underpin, the best of both, the final salary and the care benefits for this period of time. But then the blue members is what Mcleod brought into scope, which is basically saying, well, there was a little bit of age discrimination there, and this was all up in the air last time, and that's why there was a big uncertainty, big question mark on Mcleod last time, and what we did, and this is obviously not a very pretty slide, but this just shows a recap of what we did at 2019, and this is in the Leicestershire funding strategy statement, and it just says that due to SAB guidance at the time, funds had to evidence what they were doing to tackle this kind of Mcleod uncertainty, and the fund chose to adopt an extra 5% margin in this future investment return assumption. So that's what we did last time. This time, as Ian's touched upon, there's more clarity on the remedy. The data won't exist yet for it to be officially in all the data that we get from Ian and his team. So what we'll do is we now have a really good handle on how to make an estimate for that. So we will make an estimate in the liabilities this time. So it will be there in the sort of starting position of everything that we do effectively. And what that means is when we come to set the assumptions, we no longer need to build in this extra bit of prudence that we built in last time. Otherwise, we'd be double counting the impact of Mcleod. So we're proposing today that when we set the future investment return assumption, we're going to strip out that extra 5% margin of prudence. So what does that mean, though, to be prudent? And there'll be more. It's worth saying that on all the assumptions, there'll be a lot more that will be brought to committee in June, and there'll be information on the future investment return, what it will actually be, and that this is an idea of a spread of returns that the Leicestershire portfolio could achieve, but this is based at March 2021. So we're making a principles-based decision on the level of prudence, but the actual numbers, Ian's quoted the kind of 4.1% future investment return. That's at March 2021. So what that, the actual 4.1% might be a different number when we come to do the valuation, but that doesn't really matter. Crucially today, what the committee is looking at is you're looking at the level of prudence, the likelihood of achieving those future returns, and that's what you'd be agreeing to. And then the actual number, the number itself, will just sort of fall out of the model when we know what the markets are doing on the valuation date. Appreciate that's a little bit of a sort of technical slide. I don't want to talk about this for ages. I'm mindful of time, but does anyone have any questions on that? The idea that there's a spread of returns, and we're sort of the red line would be the best estimate, but clearly we need to set a prudent assumption. So we're taking a kind of cut to the left of that line.
Thanks very much, Tom. Has any member got any questions they'd like to ask? I think that was well explained. Oh, Claire. Claire, if I could bring you in, please.
Thank you, Chair. I just thought it might be helpful for the committee to understand what implications this change of prudence would have on the funding level in isolation. You said the actual Mcleod resolution would be around about 1% of the liabilities. What impact on the funding level would this be? So what impact might we see overall?
Yeah, no, thanks, Claire. I'm glad you asked that question. It's almost like a planted question. So I'll just quickly move on to this to hopefully bring that question to life. So Ian mentioned this before, and that in isolation, moving this one assumption will improve the funding position by around 5%. Okay, now yes, when we build in the Mcleod allowance, I've said it is about 1% of liabilities. That's probably over egging the pudding a little bit. So we took this approach for the 2020 Scottish valuations, and it was probably closer to about 0.1% of liabilities. It's a very small number, the estimated impact of Mcleod, for a number of reasons, which I'm happy to talk about. But I appreciate we don't necessarily need to go into that today. So in isolation, moving this assumption, effectively we were over prudent last time. Now that's not a criticism of what we did or what Ian and his team did or the fund did. All funds were taking a similar approach. It was a big uncertainty, but so we're stripping that back. It's now a sort of fairer pitch. We're valuing Mcleod probably as it should be valued, and we're back at the likelihood that we were going to set last time, before Mcleod kind of intervened. So what it does is it moves the funding level by 5%. So sort of just quickly explain what we're looking at here. Now we did see this last time in September. Again, a little bit of a technical chart, but the slope line, the orange slope line across the middle, is the funding level, and that funding level would be different if you assumed a different future investment return assumption, which are the x-axis, so along the bottom. So we picked out the two points. So the blue line is what we quoted in September. We said, well, okay, the fund's about 100% funded at March 2021. Now, had we said, oh, okay, well, that was us targeting 80% chance of getting the future returns, which translated to a 3.8% future return assumption. But if we said, well, okay, let's loosen that a little bit. Let's only target 75% chance of getting the future returns, which is, it's worth saying, is still a very prudent assumption. It's 3 out of 4 chance of hitting those returns. So you're definitely ticking the box on prudence. And so that would nudge it up a little bit. So you'd be targeting higher returns. Higher returns would obviously be good news for the fund, which improves the funding level. So it boosts it to about 105%. Okay, so the one final point I want to make on this, and Ian touched upon this, what does it mean for contributions? Like, everything we talk about today, that I appreciate there's some employer representatives in the committee. That's all good and well, talking about funding level and things, but like, what's it going to mean for employers? Potentially, what does it mean for the fund? And obviously, Claire might be interested. What does it mean for investment strategies, things like that? So the point of this next slide is to say things don't end. We don't just get to 100% funded, or we're now potentially better than 100% funded and close shop and say, well, we've done our job. This graphic, what this shows is that the red bars is the past service. So we're 100% funded, but that's only the past service. That's everything earned up till now. But actually, over the next 50 years, 2/3 of the future benefits that the pension fund will pay will be in respect of future service. So that's service that hasn't yet been earned. Okay, and that is the primary rate, the primary contribution rate. So while this, this past service funding position, this improved funding level will affect those red bars, and basically we're saying, okay, we're slightly better funded. It doesn't, it doesn't have as much as an impact as what you might think. The cost of future benefits is actually much more important, and the cost of the primary rate is much more important. And what we talked about last time in September, and Ian had it in his paper last time, the cost of future benefits has gone up since 2019. So what does it mean? All of it in aggregate, it might mean that we might have a chance of seeing reasonably stable rates for employers this time round. Some may still go up, but by moving this assumption back in, that's going to offset some of the increases that which would have otherwise been realised through the increase in primary rate. So yes, it's too early to say. We're only at November. It's not March yet. But in aggregate, that this might mean that we're hopefully going to be able to set reasonably stable funding plans for most employers. So I think that's just a summary slide. I won't touch on that. We've talked about it, and this is just again to show that we showed this last time, that the fund's doing lots of stuff already, lots of preparatory work. The valuation's a long process. I've highlighted two things. We're talking about assumptions today, but we've mentioned already we're going to bring back the full complement of assumptions in June to committee with all the analysis, all the other assumptions, which is some really good stuff for you to look at. So I want to give Stephen just sort of 5 or 10 minutes, if that's okay, just because I think it is really useful for the committee to understand what's down the track for the rest of the assumptions. We won't be setting the assumptions today, but I think the committee would have an interest in knowing what other assumptions and what's going on with them, if that's okay, Chair.
That's fine. Thank you, Tom. So if we could invite Stephen to do his presentation.
Yeah, thanks, Tom, and thanks, Chair. So today I just wanted to chat on or touch on some of the other assumptions that will feed into the valuation calculations, and also just kind of signpost some of the things that will be coming your way over the next few months. Just to echo what Tom and Ian have mentioned, and for the avoidance of doubt, we'll not be setting any of these assumptions today. However, we are just want to give you a flavour of what's to come, and if you have any questions as we go through, please feel free to interrupt. So the first one I'd like to discuss is the inflation assumption. So as you'll have seen in the news, lots of headlines recently around increasing levels of inflation, and the significance for this, for the fund being in the LGPS, is that members' benefits are largely all inflation linked, and the long-term inflation assumption will therefore impact the present value of all your members' benefits. So all other things being equal, inflation increases, the cost of benefits increase, and that leads to an increase in liabilities, and vice versa if inflation went the other way. So it's probably a little too early to say at this stage what this kind of short-term impact has. However, the kind of analysis that's been so far is it's kind of tending towards a kind of stable 2% rate, which we'll come on to later on. So to date then, a long-term inflation expectation has nudged up by around about 0.25% per annum, which roughly translates to something in the order of magnitude around 4 or 5% reduction in funding level. So that's the kind of scale that we're talking about here. The inflation assumption that we set for 2022 will be set by us as actuaries, and we'll use a long-term inflation model for this. So this will capture both this kind of short-term stuff that you've obviously seen in the news recently, and it will take into account this kind of longer-term expectation. So if I just draw your attention to the kind of right-hand side of this chart, just wanted to quickly chat about the forecasts and the difference in the forecast between March 21 and only last month in October. So the green line there is the March 21 forecast, which you can see is quite low in comparison to the October one, and I think this kind of brings home the message of there can be quite a lot of volatility in the short-term rates in terms of the rates over the next couple of years. However, we as actuaries and to set your valuation assumption, look at the kind of long-term rate, which we can see as all of those kind of projections all tend towards that kind of 2% level. So it is that long-term assumption that we use when we're setting the valuation assumption. So what does this mean for you? We'll carry out some further analysis in the coming months, both on the inflation assumption, so CPI, and also on the salary increase assumption, which is set relative to CPI, plus some small additional margin. And once this analysis is completed, we'll come back to you and present this to you in around about June 2022 time. Just move on next slide, Tom. Thanks. I guess that's just quickly pause there and see if there are any questions.
Yeah, there is a question, Louise.
It's just about the assumptions. There's so many different assumptions. My assumption would be that inflation would rise more than that, but you don't want to take that on board. Whose actual assumption do you take? Is it a Hyman-Robertson assumption or a government assumption? Which one do you actually use? Yeah.
Yeah, so the long-term assumption is, or the inflation assumption is derived from Hyman's. So that's an in-house view, if you like. We use our long-term model and model all these future projections of the assumption. So it does feed into the current inflation levels that we see in the market today. However, it is derived by Hyman's. I don't know if Tom, you want to add anything on that?
No, I mean, I just very quickly echo Stephen's point. I think the slide, our model, this is the OBR projection in October, but our model does something very similar. It captures short-term market, influences, but then it does tend towards the longer term. So in the shorter term, there's an allowance for what's going on in the markets, and sort of market implied inflation, but then it does towards the as the model runs on, it does tend towards kind of economic policy, which is it kind of tends towards a sort of long-term 2% rate. I guess just to give you a flavour for different actuaries, obviously take slightly different approaches when they're setting the CPI assumption, but it's a very small. It's not as wide a range as you'd see on the future investment return assumption across the other main actuaries that advise the public sector. You're maybe going to see a spread of about 0.1, 0.2 between the different CPI assumptions. So it's not one necessarily that the committee would be expected to get involved in. Is probably worth saying.
Thank you. Thanks for that. It's particularly different to project. I think even the Bank of England Monetary Policy Committee struggle with this one, so we'll see what the reality turns out to be. But thanks for that answer.
Thanks, Chair. So the second point then today I want to touch on is another topical issue, which again has been in the news plenty over the last couple of years, and that's longevity. So the longevity analysis that we use at the valuation is provided by Club Vita, who are a market-leading longevity firm. Longevity is an important assumption at the valuation, as you can imagine, the longer people live, the longer the members' pensions are paid, and that obviously places a greater strain on the fund's finances. So here on screen, we have a kind of heat map of the Leicestershire area, with going from red to dark blue represents like a sliding scale of lower to higher life expectancy. So if you're interested and you can see the screen well enough, you can try and zoom in and find your area. However, I just wanted to touch on that quickly and highlight that we know this is a really interesting area for everyone, and we'll be back with some further information on this next year. And a kind of key message to take away just now would just be to say that the assumptions we use at the valuation is tailored specifically to the Leicestershire Fund members. And this is what you can see on screen just now is really just a snippet of all the different bits of information that we look at. If you just move on, next slide, please, Tom. So one thing that's still very much unknown is what impact the pandemic will have on the future long-term life expectancies. I think you've seen this slide back in September when Tom and Richard presented, so we just wanted to touch on it again. And obviously, as you know, there's many different theories out there, some of which we've got on the screen, on how these different theories will impact long-term improvements. So you can read that at your own leisure. I believe it's in your pack, but we'll not spend too much time on that one. Just skip on to the next one, please, Tom. Yeah, you can just fill it in. Okay, so having tuned into the daily Downing Street press conferences for over a year now, I think it's clear to say that in the short term, the pandemic has definitely led to an increase in excess deaths. However, the longer term impact is probably a wee bit unsurprisingly unclear at the moment. So highlighted here, we've got 4 different alternative scenarios that we think might play out, and we've kind of just highlighted, and you can see just in the numbers that runs down the impact on the liabilities under each scenario. So just going from the top, we have a kind of bump in the road scenario, which might suggest that in the next few years things kind of revert back to normal, with liabilities roughly staying the same but coming down a little bit. The next kind of theory would maybe be innovation in adversity. So this is kind of like almost a reset people lead to healthier lifestyles, healthcare systems are better equipped, which would lead to an overall increase in life expectancy and liabilities. Or alternatively, we might have a more pessimistic view in terms of the long road to recovery and healthcare decline options at the bottom, when things just become quite a bit damaged, and this leads to reduced life expectancy, which also brings down the liabilities. So just kind of key takeaway from here is it's too early to say right now. However, we will be doing some more further detailed analysis as part of the valuation next year. Next slide, please, Tom. Oh, thank you. So just to finish off, some of the other demographic assumptions that Ian and Tom alluded to earlier are things like commutation levels, number of ill health cases, proportion of fund members who are married, and so on. There's a few other ones on the screen just now. But just to assure you that the fund specific demographics, including these ones you can see, will all be analysed, and there'll be further reporting on these early next year. So just finally, just to have a quick recap on what the key assumptions that we've spoke about, just ranking from highest impact to lowest. First of all, we have the future investment return assumption, which Ian and Tom have touched on earlier this morning. Next, we have the inflation assumption, which is set at our best estimate assumption using the long-term inflation model. We then have the longevity on mortality, which is tailored specifically to the Leicestershire Fund members, and we use Club Vita analytics for that. Next one then is the salary growth assumption, which is set relative to CPI with some small margin included. And then finally, we have our other demographic assumptions, which will be reviewed as part of the membership reconciliation that we do as part of the calculations next year. So now we've kind of given a high level of the other assumptions. I just want to finish off by saying that once the market conditions are all confirmed and all available as at 31 March 2022, all these assumptions will be agreed and presented to you back at the June 2022 committee for your approval. So again, I'll take a time to pause there and welcome any questions.
Okay, thanks very much, Tom. I think we certainly covered every possibility, and we look forward to receiving the report in June 22 with when the market, see how the markets react. Has anybody got any other questions that they'd like to ask? Councillor Clark.
Thank you very much, Chair. Yeah, fascinating and a very clear presentation. Just one question, which might seem quite rudimentary. The size of the fund obviously depends on the size of the public sector. And so to what degree does the shrinking nature of the public sector have an impact on the size of the fund, and therefore on the on the ability of the fund to invest wisely and create returns? That's obviously, there's been huge changes in the public sector over the last 10 years, and we're projecting it continuing to shrink, and that doesn't seem to be factored into the assumptions.
Thank you, Tom.
Yeah, I'm happy to take this one. I don't know if Ian and his team might have some comments on this as well, but so I appreciate the comment about the public sector, and it's certainly not unfounded, but the fund itself, I think when it comes to funding and when it comes to the long-term nature and looking at investment returns, what was crucial is we refer to it as maturity. So the maturity of the fund or the maturity of any employer, and that's to do with effectively the cash flows. Are you cash flow positive, cash flow neutral, cash flow negative? That's the key driver when we're looking at the pension fund. If you're cash flow negative, that's the situation that the question sort of refers to. That would be when you've got more pensioners than you do have new members, and then the money coming out is coming out quicker than the money going in. We're not there yet. It's actually the fund. Different funds are in different positions across LGPS. The Leicestershire fund is still quite cash flow positive. Yes, it is it's a salient point that the fund will need to monitor. It's something that as a risk that the committee should be aware of and should continue to monitor. But you're not, you're a good way off that. unless there was a sort of seismic change in the LGPS where some sort of government policy or whatever, and loads of people were taken out of the public sector or the LGPS pension scheme, then it's not one that should be on the radar in the immediate future.
Just sort of from the I suppose just give a bit more detail on what Tom's put. What we've seen over the last few years is the number of contributors in the fund kind of increasing at quite a healthy rate. If you go back, say, 3 years ago, things were flattening out. We were getting a bit worried about that. Was that the tipping point of going from positive to negative cash flow? But I think as kind of government kind of cuts have stopped and the public sector pressure sort of locally is more about kind of managing demand pressures, we're actually seeing the number of people increasing across the board. And bear in mind, I suppose it includes administrative staff in schools, as well as kind of universities, fire, police, as well as the council. So there's quite a broad base, but we have seen that kind of, like I say, it was getting to that sort of grinding to a halt, but we have sort of picked up with contributors again. So we feel like we're going to be okay for a few years on that.
Thank you, John. Thank you, Declan. Good points. So, Zubair, do you have a question?
Thank you, Chair. I have a comment and also a question. The comment I wanted to make was just to say on Ian's presentation, the section 15 regarding the proposed framework. I just wanted to say I think that's a really good thing to see, and it's welcome. The proposal is as you say, trying to achieve fairness, I think, for employers, which is really good. And the proposed framework seems really sensible as well. I just had a question in that respect, was for sort of my understanding, and possibly for the committee as well, is just very briefly, how would those employer funding levels be informed, and within the timeline, when do you expect that to have taken place?
I'm happy to comment. I don't know if Ian wanted to jump in first.
Ian, would you like to say something? Yeah.
Thank you. Yeah, I was just looking at the timetable in the report itself. So I'm just going to scroll down. We should have stabilised employers indicative rates by April 22. Calculate the full fund Hyman. So I would suggest, looking at this timetable in the report itself, we'll have the full rates by April 23 when we'll implement, but clearly we'll have the information before then, Zubair, and we'll be liaising, as I did last valuation, liaising with the employers from about the November prior to that. So we'll be talking to yourselves and others. In fact, we're already speaking to you about some of the risk rates already, so that work's already started. But that detail is in the table, Zubair. Is that okay?
Yeah, that's fine. And I think the other, so in terms of, just very briefly, in terms of how you would actually get to how you would inform that employer funding level is, are you able to just touch on that very briefly? So we're talking about, just to be clear, within the table in section 15, we see different levels of employer funding, so less than 100%, etc., etc. Just a very broad question in terms of how would that be informed?
I'll liaise with each employer individually, Zubair.
Okay.
So once I have the information from Hyman's, we'll liaise with Hyman's. We'll work through each individual, as we do in the valuation previously, Zubair. Each employer has its rates specified in the valuation report. I'll work through them individually, employer by employer, and I'll be liaising with employers throughout that process, as we have in the past.
Okay, so it's Hyman's will undertake the calculations to determine the funding levels, and then
yes.
Okay, that's fine.
Yeah, sorry, big one. Yes.
Yeah. No, thank you. Appreciate that. Thank you.
Great. Thank you, Zubair, for the question. I think that fully answers the question. Now, Tom, do you have anything else you want to say or not?
No, that's fine. Ian's answered that. Thank you.
So we've come to the end of the presentations. If no other member has any comments, and it doesn't look as though they have, We are asked to approve the assumption for the likelihood of meeting future investment returns at 75% for use in the 2022 valuation. And we are also asked to note the remaining assumptions set out within the report. Is that agreed by everybody? Yeah, so that's unanimous. Thanks very much. So the next item is item 7, which is the responsible investing update as set out on pages 46 to 49 to page 118. For this item, members will be aware that we received representations from Climate Action Leicester and Leicestershire that were circulated a few weeks ago and also published as a supplementary pack to the agenda. We welcome Zena and Neil to the meeting today, and I understand they would like to say a few words. So I would advise if you just take a seat wherever you like, and if you could limit your comments to 5 minutes, that would be appreciated. Thank you.
Hello, thank you for allowing us to speak today. I'm Zena Zelter and this is Neil Adams, and we're part of Climate Action Leicester and Leicestershire. Obviously, as a pension committee, your duty is to ensure that this fund is able to pay your members' pensions. And equally obviously, if climate change passes 1.5 degrees centigrade of global warming, then the international financial system is likely to become unstable and threaten that capacity to provide pensions. So investing to minimise climate change makes sense. We've given you this report because we feel it makes 3 things clear. Firstly, that investing in fossil fuels is becoming financially risky. Secondly, that divestment from fossil fuels does fit within your fiduciary duty. And thirdly, that the process of engagement with fossil fuel companies is not working fast enough to keep the world below 1.5 degrees Celsius of global warming. Taking these in turn, let's start with the problem that investing in fossil fuels is financially risky.
This is due to the international shift away from fossil fuels and to renewable energy, which
Neil, if you just, that's it.
This shift means it is extremely likely that at some point in the next few years, international requirements and legislation are going to be put in place to phase out fossil fuels. The evidence of this can be seen at COP26, the international climate negotiations earlier this month, where the phasing out of fossil fuels was seriously discussed and the phasing down of coal was agreed on. Even without this kind of legislation, though, the shift away from fossil fuels is happening. Solar, wind and battery technology are now much cheaper than fossil fuel extraction, and this will eventually put an end to the fossil fuel industry. The question is, will it happen fast enough to prevent catastrophic climate change? The second point in our submission is that divestment does fit with fiduciary duty, and particularly want to point out, firstly, the reference to BlackRock and Mcleod. This shows 2 major investment advisors doing separate studies, with both finding that fossil fuel divestment did not have a negative impact on investment funds. Secondly, that both LGPS legal advice and Law Commission guidance say that fiduciary duty rules do allow pension funds to consider ethical factors in investment decisions. And thirdly, that 5 local government pension schemes in the UK have already fully divested from fossil fuels, 2 of them over 5 years ago, without negative financial or legal repercussions. Given that oil prices are trending down since 2008 and divesting from fossil fuels has been shown to have no negative financial impact on funds, why take the chance on these investments? The recent surge in energy prices gives you a significant opportunity to sell into strength. There is no fiduciary duty to invest in risky companies.
So the third strand of our submission is about the effectiveness of this fund of engagement, which we would ask you to reconsider. The question is not, would engagement with these companies work if there was more time? It's, is engagement able to work fast enough to get a sufficient reduction in the production of fossil fuels to help prevent catastrophic climate change? Please would you consider the following in our submission. A survey of 64 institutional investors with trillions of dollars in assets found that only 17% believe oil groups will transform their businesses to focus on green energy. And in April this year, the local authority pension fund forum said that it believes Shell's net zero plans are unreliable. Not surprising, given that Shell, who you've heard cited as being responsive to engagement, is in the process of opening the Cambo oil field in the North Sea. Cambo will produce emissions equivalent to 18 coal-fired power stations running for a year in just its first phase. Engaging with fossil fuel companies rather than making a public divestment commitment effectively provides cover for these companies' ongoing attempts to block and slow down effective climate action. If you want to help reduce the world's carbon emissions, then it would be more effective to publicly cease to invest in fossil fuels, to invest more in renewable energy, and to engage with your other investments to get them to reduce carbon emissions. Please would you divest from fossil fuels and put your weight behind the growing call for regulation to require a fast transition to renewable energy. This is an opportunity for this pension fund to be proactive, forward-looking, and help to achieve net zero in Leicester, Leicestershire and Rutland, thereby helping to keep the world below 1.5 degrees of global warming. Thank you.
Thank you very much, Neil and Zena, for your presentation and for your contribution today. The fund does wish to acknowledge the efforts of the group aiming for a decarbonised future. With respect to the representations made before at the September Pension Committee and today, together with a written submission for the case for fossil fuel divestment, you will hear today the fund's approach to further address the challenges climate change poses. The purpose of the fund is to ensure that pension benefits can be paid when required. The fund faces numerous risks, but as a world-changing event, it is only right that climate change is seen as one of the principal risks. The agenda item outlines the findings and recommendation from the second climate risk report the fund has undertaken, together with the progress made since the first report and further recommendations for the committee. This will support our management of the climate change risks, with an ordinary transition to net zero being viewed as the best outcome. One key recommendation is to commence work on a climate strategy with the implied ambition of reaching net zero. Pulling together our approach in one document will improve the clarity about what we are doing and the pace of change. At the current time, the fund does not see divestment from carbon-intensive companies as the best way to manage the climate change risk. This is in line with the direction from the UK government to continue engagement with companies to influence their actions before any divestment decision is taken. Divestment has no impact on the world's carbon footprint, and in some cases, divestment will remove green investment exposure from the fund. No company is insulated from the economic impact of extreme global warming. Hence, engagement is more compatible with our fiduciary duty and more supportive of responsible investment, as it provides the opportunity to influence the companies, something that is not possible if the investment is simply changed and sold. Climate change rightly needs to be at the front of our minds when making investment decisions, but taking a responsible investment approach is the best way forward for the fund. I thank you both, Zena and Neil, and you're more than welcome to stay and hear our climate change presentation and the actions that we are proposing. I thank you both for coming along. So, and presenting it. We have listened, we have learned, and we understand what you're saying. I will now pass to Bulesh, Senior Investment Advisor, to introduce this item, and we welcome Valborg and Amelia and Patrick from LGPS Central for the presentation that they will also provide. So over to you, Bulesh.
Thank you, Chair. Just going to wait for our colleagues from LGPS Central to take the seats. So we've got 4 items to cover, and 3 of the standard items on this report that we bring quarterly to the committee. One is our annual climate risk report, and I'm happy to have Amelia and Patrick from LGPS Central to assist us. We do have a presentation that accompanies this report as well. We have Val on Teams available for any engagement stewardship type questions as well. I'm just going to flick over to the second page. We've got a section here starting at point 10 for the climate risk report. I won't steal much of Central's thunder here, but we've got some brief highlights before I hand over. The report contains updates on the 12 recommendations in the 2020 report, which was brought to committee about this time last year. Progress has been made. We've got progress against 10. Five have been completed. The ones that haven't will be carried over. And we've got a list there in point 11, A to F, with the top one being developing a climate strategy, and we're proposing to bring that back to committee sometime in 2022. Point 12 talks about the metrics that we use to measure the climate intensity, or the carbon intensity, sorry, of the fund. We've got more detail on how we calculate those and the other metrics as well within the presentation. Let's say that, you know, we've got a reduction year on year. There's some important metrics within there, including tons of carbon dioxide emitted per $1 million of revenue. We've got metrics on the weight in fossil fuels and the weight in clean technology. We've got a section on our fund's position on climate change, which the chair has just read out, so I won't go through those points again. They're covered in points 17 through to 22. Again, pointing out that at a recent local government investment conference, there was a drive to carry on with engagement before divestment decisions are taken. On the subject of a climate strategy, one of the recommendations is to write a climate strategy, and it's alignment with the TCFD recommendations. We cover that off in points 24 and 25. If I just move over to point 27, one of the bits that we'll have to be careful about in writing a climate strategy is detailed in points 27 there. So we want to present for approval in 2022 long-term and intermediate targets that are at least Paris aligned. And we want them to be relevant and reliable metrics that the fund can routinely measure and gauge performance against these targets. We recognise that other measures may deem to be beneficial to decarbonise the future, such as a share of green revenues, for example. We need to be mindful that we need to be flexible in the event of future changes in legislation, and then also develop reporting to cover more of the fund's assets. We are aware that not every asset within the fund is currently reported on for their climate footprint, such as infrastructure at the minute or bonds, etc. So over time, we aim to increase the number of, or the percentage of the fund that's covered. Lastly, we normally review the ISS, which is the investment strategy statement, around this time of the year. We've given it a high level overview, but we think it's important at this stage to complete a climate strategy and then go back and review it in more detail thereafter. We do have the standard quarterly voting report in here and the update on the responsible investment plan at point 38, but I think it's probably a good time to hand over to Millie to talk through our 2021 climate risk report.
Okay, so over to you, Millie.
Thank you very much. Good morning, and yeah, just to say thanks very much for having us here today. We're delighted to be here presenting to you. So as Bulesh mentioned, my name is Amelia Gaston, and I'm one of the RINE analysts from LGPS Central. I'm joined today by my colleagues, Patrick O'Hara, who is the director of RINE at LGPS Central, and also Val Borgley, who's on the line, who is the stewardship manager. And today we will be presenting the findings from Leicestershire Pension Fund's 2021 Climate Risk Report. And this was a report commissioned by Leicestershire Pension Fund and written by ourselves at LGPS Central. And the purpose of our presentation today is just to present the main findings of this report. So if we move to slide 2, as you can see, I intend to go through each part of the climate risk report in turn. So I'll just begin by giving an introduction to the climate risk report, so outlining what the purpose of the report is, the questions it looks to answer, and also how it can be used by the fund. I then intend to go through each of the main analytical sections in turn, and as I do this, I will outline what method of analysis was used, what it aimed to do, and also the results of that analysis. So as you can see on the slide, I'll sort of go through the main 3 sections of the report, which are governance, carbon risk metrics, and then finishing off with climate stewardship. So if we move to slide 3, which is about the report purpose. So what is this report trying to do? Well, the climate risk report aims to identify, as far as we can, the financially material risks and opportunities that the fund might be exposed to from a climate change perspective. We're not addressing this from an ethical or a moral perspective. What we're trying to do is look at whether climate risk translates into a financial risk. And I want to be clear from the outset that we're not claiming that this report has all the answers. You know, as you're aware, climate change is a highly complex issue. It'll affect all asset classes, sectors, regions. As a result, there are some limitations with how much confidence you can have. But what we do think is that investors looking to manage climate risk proactively ought to attempt an inference to the best explanation. And this is what this report is trying to do. So essentially, it draws on some of the best methodologies that we can find to help the fund understand both the types of climate risk that it may be exposed to and also what it can do to manage those risks. Now, this is actually the second year that Leicestershire Pension Fund has commissioned a climate risk report. So they also commissioned one last year in 2020. And in last year's report, we were able to gather a baseline of data. And this was very useful because it told the fund where it was at that point in time in terms of climate risk management. And what we are actually able to do now is compare those results to the new data that we've gathered this year. So essentially, we can measure progress against that baseline and demonstrate in quantitative terms how far the fund has come in the last year. And based off these results, there are also a number of actions the climate risk report can assist the fund in taking. So as Bullet mentioned, this includes things like formulating a climate strategy, updating its RI action plan, and also continuing to report against the TCFD recommendations. And just in case anyone isn't familiar, the TCFD stands for the Task Force on Climate-Related Financial Disclosures. And it's sort of very much become something of a global standard for how organisations, and this isn't just pension funds, but it's also banks, asset managers, companies, how these organisations should report on their approach to managing climate risk. Therefore, sort of reporting against these recommendations, which the fund did for the first time this year and does intend to do so annually, does put Leicestershire Pension Fund sort of within the vanguard of UK local authority pension funds. And our climate risk reports, so that which I'm presenting today, are deliberately structured to align with these recommendations, just to assist the fund in making those annual disclosures. So if we move on to slide 4 and start to go through some of the analysis, the first pillar of the TCFD is about governance. So it's about the policies that the fund has in place. And in the fund's first climate risk report, so last year's report, what we did was a desktop review of the documentation that was in place for the fund. And we provided an analysis outlining the existing arrangements and also what the fund could do to build on and improve its governance of climate risk. And based on this analysis, we provided 12 recommendations to Leicestershire Pension Fund. And these are all things which, in our view, would sort of further embed and normalise the management of climate risk into the fund's governance and into the fund's policies. And just to note, these recommendations, they all had kind of medium-term horizons, so they weren't designed to be implemented right away. We sort of envisioned the fund enacting them sort of over the course of a few years. So if you look now on the graph on the left-hand side of the screen, you can see that out of the 12 recommendations, 5 have been fully completed, whilst another 5 are currently in progress. The remaining 2 haven't been addressed yet, but it is likely that this will change in the coming years. And as per the box on the right-hand side, sort of some of the key developments that the fund has made in the last 12 months include things like publishing its first TCFD report, enhancing and updating its RA action plan to make it more ambitious, including climate change as a regular item on pensions committee meetings. There's been climate change training which has been undertaken. Climate risk has been included in the fund's risk register. And also the fund's annual report has been updated to include a greater amount of climate change disclosure, reflecting the fund's sort of significance of the issue. And what this demonstrates is that the fund has made considerable progress in terms of its responsible investment and climate change practice in the last 12 months. You know, more can be done, but the fund has already indicated its intention to do this. And as Bhulesh mentioned, it's currently looking at producing a climate strategy and will update its RA action plan as well. So if we move... Wonderful, thank you. So if we move now on to the next part of the report, which is the carbon risk metrics. So that's on slide 5. Now, this method of analysis is bottom up and it considers Leicestershire pension funds equity investments. Unfortunately, at this time, data limitations in other asset classes means it can't be extended beyond this. But the TCFD recommends for pension funds that they disclose at least a portfolio carbon footprint. In the climate risk report, we've actually looked at several numbers because we don't think, and most peers would agree with us, that you can place all your faith in just one number. The best thing you can do at the moment is look at a range of numbers. And you can see the 4 key metrics we've used listed on the left-hand side of the screen. So before diving deeper into the results, I'm just going to explain a bit more about the metrics and how they are calculated. I'm sure some of you will already be familiar with these, so apologies if there's a bit of repetition here. But just for the benefit of anyone who's not seen them before, I'm just going to spend a few moments going through them because it does very much help to contextualize some of the numbers which are about to follow. So if I start off with portfolio carbon footprint, and I'll just refer to your total equity carbon footprint here, which is 120 tonnes of greenhouse gases per $1 million of revenue. Now, what this means is that every time, on average, the portfolio's companies sell $1 million worth of goods and services, they also emit 120 tonnes of greenhouse gases. So this is their carbon intensity. And you can think about this as one company operating. So completely hypothetically, if we took BP, if every time they sold $1 million of goods and services, they also emitted 100 tonnes of greenhouse gases, their carbon intensity would be 100 tonnes per $1 million of revenue. Now, if you think of another company, again, hypothetically, if we take Rio Tinto, if their carbon intensity was 200, what this would mean is that every time they derived $1 million of revenue, they would emit 200 tonnes of greenhouse gases. Now, if you had a portfolio that was weighted 50% in BP and 50% in Rio Tinto, your portfolio carbon footprint would be equally split. So this is the way the portfolio numbers are calculated. So you get the weights of each of the different stocks in the portfolio, and then you sort of multiply those weights by the carbon intensity of each of the different stocks. Now, sort of a question worth asking here is why this would be of relevance to an investor, you know, beyond simply a standard asking someone to report it. Well, people think about it in a risk management context. So obviously one theory about climate change is that policymakers are more likely to introduce policy measures which are more and more punitive as time goes on to carbon inefficient companies and more supportive of carbon efficient companies. You know, you can think about this as a carbon tax. So a company that was generating a certain amount of profit and emitting a lot of carbon would have a competitive disadvantage compared to a company that was generating similar profits but emitting less. You know, if you had to pay $100 of carbon tax for every 100 tons emitted, this would punish the carbon intensive company more than the carbon efficient company. So this is how the portfolio carbon footprint works. And aside from this, we've also looked at the weight that each portfolio has in fossil fuel reserves and thermal coal reserves. So companies that are said to own fossil fuel reserves, they can be companies like BP and Shell, but they can also be diversified businesses. So ones with sort of a range of underlying companies, one of which owns reserves. And to work out the metric, you add the weight of all the companies that own fossil fuel reserves and then compare it to that of those in a benchmark. And then sort of the last metric we looked at was weight in clean technology. Now, clean technology includes things like energy efficiency in buildings, uses of alternative energy, water efficiency. And here the data is slightly more patchy, sort of slightly more so than the other metrics we've used. You know, things like who makes what kind of clean technology is evolving all the time. And also what is actually defined as clean technology does vary a bit between different suppliers. In good news, the EU is coming up with a green taxonomy, which will standardize things sort of in years to come, but we sort of don't quite have this yet. So sort of looking back at the slide, you can see on the right-hand side all of the portfolios that we were able to analyze as part of this exercise. And you can see that sort of the high-level passive equity portfolio and active equity portfolio are sort of aggregations of the carbon risk metrics at underlying level. And what this means is that all of the fund's equity investments are captured in the results presented on the next slide. So great. Moving on now, and this is slide 6 that I'm about to talk about. So just sort of providing some sort of flesh to what I've just explained. What you can see here is an overview of the carbon risk metrics at total equity level, and then also broken down into active portfolios and passive portfolios. So here, what you can see is how the carbon risk metrics have changed between 2019 and 2021. Just for clarity, the 2019 data is the baseline that we gathered in your first climate risk report, so last year's report. So wherever you sort of see 2019, it refers to data as of the 31st of December 2019. The 2021 column is the latest data, so that's what we produced in this year's climate risk report, and it uses holdings from the 31st of March 2021. And what you can see in the table is the general direction of travel for the fund from a climate change perspective. So things like how your portfolio carbon footprint, how your weight in fossil fuel reserves, how these have changed during the past 15 months. And there are 4 things which I'd like to draw your attention to, and they're sort of highlighted through the coloured circles on the slide. So firstly, and looking at the red circle, you can see that in the last 15 months, the carbon footprint of the total equity portfolio has decreased by about 25%. And, you know, this sort of means that on average now, for every $1 million worth of goods and services that the companies in the portfolio sell, they're now emitting almost 25% less tons of greenhouse gases. So, you know, this is a very positive finding. And the yellow circle indicates the driver of this result. So as you can see, it was very much the passive equity portfolio which was crucial to driving down the carbon footprint at the total equity level. And this stems from the fund's asset allocation actions. So most notably, the decision that was made to transition assets out of the two LGIM FTSE RAFI portfolios and into the LGPS Central Climate Multi-Factor Fund. Our analysis showed that the Climate Factor Fund was significantly more carbon efficient than the two LGIM FTSE RAFI portfolios. And so this drove down the carbon footprint at the total equity level. This asset allocation change was actually also a key driver of the reduced allocation to fossil fuel reserves at the total equity level. So this is highlighted by the blue circle. And as you can see, between December 2019 and March 2021, the total equities exposure to fossil fuel reserves decreased by 2.3%. And then lastly, as per the purple highlight, the exposure of the portfolio to companies with green reserves has increased by almost 5%. And this means that the fund now has a greater exposure to those companies which are driving forward the low carbon transition. And sort of the key takeaway here, if you're sort of going to remember one thing, is that on average the results are positive, and it does suggest that the fund is moving in the right direction in terms of climate risk management. You know, there is more to be done. It's a journey, but in that journey, the fund is currently going in the right direction. So if I move on now to slide 7, in the fund's 2020 climate risk report, we recommended that Leicestershire Pension Fund create a climate stewardship plan. Now, what this is a focused list of companies that the fund can watch out for or ask its portfolio managers for progress on. And these companies are listed on the screen. And they're the ones which very much stand out from the bottom-up analysis we've done. So it's these companies which are sort of influential in driving up some of the numbers from the previous slide. So the companies with sort of a higher carbon footprint or a higher exposure to fossil fuel reserves. Now, the climate stewardship plan reflects the fact that it's not possible for Leicestershire Pension Fund to ask about climate risk for every company within the portfolio. You know, the fund invests in thousands of companies. However, what it can do is monitor a watch list of companies, and these are the ones which, based on the quantitative analysis, are the ones which are most worth asking questions about, the ones which are most worth sort of engaging with and trying to change. So as I said, you can see the companies included on the climate stewardship plan listed on the screen. And as part of the fund's 2021 climate risk report, what we've done is tracked engagements with these companies, and we've provided a progress update detailing the steps that the companies are making and the progress that the engagements are making. And sort of before we dive into some of the company level results, I'm just going to run through 2 tools that we make use of, which in our tool are very, very valuable when looking at engagement. So this is the Transition Pathway Initiative, and then the Climate Action 100+ Net Zero benchmark. And progress monitors against these 2 assessments for the companies which are included in your climate stewardship plan are included on the screen. So just sort of explaining, you know, what these 2 tools are about. Starting off with the TPI, which is the Transition Pathway Initiative. This tool evaluates companies based on 2 parameters. So firstly, it looks at their climate risk management quality. And secondly, it looks at their carbon performance. Now, the climate risk management quality refers to a company's management of carbon emissions and its management of the risks and opportunities related to climate change. So it looks at things like a company's policies, its strategy, risk management and targets. And there are 6 management quality levels that a company can be assigned to. So level 0 is the lowest and level 4-star is the highest. Now, the second assessment as part of the TPI is carbon performance. So this looks at companies' expected future emissions pathways. And based on those emissions, it gives companies a rating from not aligned through to below 2 degrees. And it's also actually looking to introduce a 1.5 degree pathway. And essentially what it does is it verifies the emissions pathway that a company is on. So whether their targets and emissions performance is aligned with Paris. And, you know, this is very helpful because obviously there are a lot of companies sort of claiming that their targets are Paris aligned. But what this tool does is it helps to validate this claim through sort of rigorous science-based methodologies. So lastly, we also use the Climate Action 100+ Net Zero benchmark. And what this is designed to do is assess the performance of the world's 159 largest corporate greenhouse gas emitters against 10 different indicators. Now, these indicators are all measures of success for business alignment with net zero emissions and with the goals of the Paris Agreement. So essentially, if a company achieves all 10 indicators, it's a very good signal that the company is successfully transitioning to the low carbon economy. And essentially, I mention these because if you sort of combine all 3 assessments, so the 2 done by the TPI and the 1 done by the Climate Action Net Zero benchmark, it does give us quite a reliable way of assessing a company's performance against net zero. And, you know, given that these indicators are updated on sort of an annual basis, we can use them to track the progress that the company is making and therefore sort of demonstrate the success that engagement is having. So the graphs on the screen at the moment, as I mentioned, they're specific to the 9 companies within Leicestershire Pension Fund's Climate Stewardship Plan. And, you know, you can see sort of on the charts, the red and yellow, this kind of indicates that the companies are not at net zero yet. They all do have areas which can be improved on. However, what we can do is use engagement to address this, and hopefully we'll see an improvement in these metrics over the coming years. So, you know, next year we'll hope that there will be more green on the charts instead of sort of the yellow and the red. So just kind of with that background to the Climate Stewardship Plan, I'm now going to pass over to Val, who's on the line, who'll just talk a bit more about engagement and its value within the investment context, and also provide you with some case studies.
Thanks very much, Millie. It's clear that there's a tremendous amount of work going on, and it is quite encouraging. But if we could ask Val now to do her presentation.
Thank you, Chair. And
yeah, could we wait till the end? That'd be great. Yeah.
Okay. Can you hear me all right?
Yeah,
can I just
hear you?
Yeah,
we can hear you.
Excellent. Great. So thanks, Millie. And if we continue then looking at engagement, and I want to reflect on engagement as both an opportunity but also a responsibility. So it's an opportunity to protect and grow value, to influence individual corporate behaviour, but also industry and sector level behaviour and markets. We would like to see stable and sustainable development. But it's also a responsibility. So when LGPS Central takes part in engagement, we represent Leicestershire Pension Fund and our other partner funds. We're stewarding long-term assets, and you don't get longer-term investment horizons than with pension funds. We're talking 50, 70, 100 years ahead. So we have a duty to be responsible owners, and we see that expectation coming out in best practice. For instance, the Financial Reporting Council Stewardship Code, which was revised recently. They are expecting asset owners and asset managers to engage their investment chain. So this is definitely becoming more and more of a best practice expectation. And another key point I want to make then, coming off of that, is that it isn't really a question of whether to engage, but how we engage. We certainly welcome questions, as were raised earlier in the meeting, around Does engagement work? Do we see progress? And are we efficient in maximising our leverage? So on this slide, there's a pyramid to the right that summarises some of the elements of how we approach engagement and how we make sure, in the second bullet point, it says, as an owner, you have a voice. We obviously want to make that voice heard. And as far as possible, we want our voting to be engagement-led. So it means that when we vote, we might escalate an engagement, we want to reinforce key expectations, etc. Another critical element further down on that list is to work with other investors, to collaborate, to make sure that we can then, in a unified manner, put across our expectations. And the Climate Action 100+ benchmark project that Millie just mentioned, which assesses companies' ability to transition in line with Paris, has got more than 500 investors globally supporting it. And it was set up in 2017. It has a sort of a 5-year horizon up to 2023. And I think it's going from strength to strength in a way. And companies are coming to this investor collaboration and asking us for input on, for instance, their climate transition plans. So I just want to highlight a couple of step changes that I think is fair to call it, that we've seen this voting season. And those changes are certainly in part due to shareholder pressure. And this is acknowledged by companies themselves. So we've seen more than 20 companies this AGM season put a transition plan, climate transition plan to the AGM, allowing shareholders a vote on how companies plan to achieve net zero by 2050, both in the short and the medium and the long term. All of these plans were passed by the AGM. Some had opposition, and we are still, shall we say, debating what a good plan looks like. And I think and this will also be sector specific. The Climate Action 100+ benchmark, again, is looking at that, and I think it's becoming a bar which will help us assess whether key ingredients are in the plan and whether it's verifiable and meaningful. Another example this voting season is Exxon Mobil, a company that has, I think it's fair to say, been slow to react to investors' demands for transition. And there were some questions around divestment earlier in the meeting. Exxon Mobil has seen some investors divest because of their slow reaction. This AGM, a minority shareholder group, succeeded in getting 3 new climate-savvy board members onto the board and 3 Exxon existing board members out. This was a very targeted effort to get real change by revamping the Exxon board, which ultimately holds Exxon to account and can set the steer for how the company develops. So I think it's quite interesting and telling that Exxon fought hard to avoid this result, but in the end they could not stop what turned out to be a majority shareholder view. The campaign actually sought 4 new board members and 3 got in. And interestingly, an impactful and large investor in the US was quoted as saying, if a whole string of funds had not divested from Exxon in the last year or 2, we could have won that vote and had 4 on the board. So that speaks again to the importance of using the shareholder vote. Now, we certainly do take concerns raised seriously around stakeholders and partner fund members asking about divestment from fossil fuel companies. I think we share certainly a view here that we would like to see a rapid decarbonisation in line with Paris. We do, however, on the left-hand side of this slide, as we've highlighted, there are some limitations to divestment. And I think we're, if we look at passive investing, selling shares in the listed equity space, selling of shares in the secondary market has little or no influence on share price. And also, I think there's something about taking a holistic outlook here. Fossil fuel companies are the supply side, which we certainly would like to transition, and we encourage that through engagement. But we can't ignore the demand side, all the energy users, the cement, steel, paper, transportation, etc. So we make an effort to send the same expectation of Paris alignment and net zero by 2050 to all sectors, both supply and demand side. And we also engage the banks that provide lending, and we have an engagement project ongoing with the big accountancy firms that check reports and accounts for companies. So we think it's very critical to take that holistic view. And I think also coming back to Climate Action 100 Plus, and I might sound overly enthusiastic here, but I am really about that project. I think it's strong. I think it's focused. We've seen some good progress. And I think at this moment in time, you could go as far as to say that we don't have time to divest. We need to keep working because we're seeing some good progress here. Yes, if we can move on to the next slide, I've got 2 slides to talk about 2 engagements. One is a mining company, Glencore, and then the next one is NextEra, which I'll come to in a minute, a US electric power and energy infrastructure company. So I think we need to be honest here and say that transition is complex, and it needs to happen across sectors, as I've mentioned. And I think those tools that Millie mentioned, we've got the Transition Pathway Initiative that assesses companies' management quality, which is more of a now assessment of how they're managing climate risk. And then the future, how are they positioned to transition? And then we've got the Climate Action 100 Plus assessment, the wheel in the middle of the slide there. These are critical tools to help keep us informed and to direct engagement and voting. And there are ongoing discussions directly with companies within specific sectors, for instance, mining, in understanding how this can happen. And I mean, there are hard to abate sectors like steel making, where at the moment coking coal is an ingredient that needs to go into that. And there are discussions of how there could be more recycling of steel, etc., and how one could potentially innovate and not need to use coking coal. I mean, we're a bit way off that, but just to illustrate. So Glencore, an interesting company. They have they're a diversified mining company. They're a major coal miner, but they're also mining metals and minerals that are critical within green technology. So amongst others, copper, cobalt, zinc, and they plan to increase their exposure to these to meet demand for renewables. They're also planning to decrease coal, a managed decline, as they call it. I would say they've gone from a laggard to a degree among mining companies in terms of climate ambition and transparency around that. They have taken some promising steps lately. They put a climate transition plan to the AGM this year, which passed. They have set a net zero by 2050 target. They set a midterm target earlier this year to reduce their absolute GHG emissions by 40% by 2035. That was increased to 50% over the summer, and that was partly down to dialogue with Climate Action 100 Plus, where we pushed them on that. We are asking them to be even more transparent around their climate policy lobbying, which is an element here which is also important. I mean, many of these companies are members of industry associations who do their own lobbying, and Glencore is a member of the World Coal Association. We are pushing them on that membership, and we think that there seems to be a bit too big a gap between what Glencore has set as their own climate targets and what the World Coal Association is pursuing, shall we say. So we had a recent meeting with the new CEO of Glencore just in October, Gary Nagle, and we pushed them on setting a 2030 target, showing the curve in this decade, which we understand is a critical transition decade. We're also pushing them to be more ambitious on this decade 2026 target, and we want more transparency on lobbying. Moving on to the next slide, NextEra Energy, which is the world's largest producer of wind and solar energy. It has been viewed as a leader because it boasts one of the lowest emission profiles in the sector, but their disclosure has been quite poor, including on carbon data and also climate policy lobbying. LGPS Central would engage them directly on the climate lobbying element, and there has been some progress there, whereby now they report annually on trade association memberships and showing whether there might be some mismatches between what advocacy happens there and what their own goals and targets are in terms of energy transition. The broader Climate Action 100+ Investor Coalition is engaging the company, and there's a push to ask them to set a clear net zero by 2050 target, which they have not yet done. But that would certainly help join up, shall we say, the short-term targets which they have set with the medium and longer-term outlook. Their largest fossil fuel dependency is natural gas currently. Our external stewardship provider, EOSAT Federated Hermes, I've had some recent discussions with them, and the company says that while it doesn't see natural gas as, it does see natural gas as an important part of the transition. Renewables are increasingly cost effective. There is that danger that utilities can improve their reported carbon footprint by simply selling off fossil fuel generation assets. But then that, at least in the near term, moves the problem to someone else's balance sheets, and the emissions in the economy is still there. So the fact that NextEra acquired a laggard, Gulf Power, recently, but is systematically bringing down Gulf's carbon emissions towards NextEra's level, we consider positive. So I think those are a couple of examples of ongoing engagements that sit within that climate stewardship plan that Millie showed you a few slides ago. And I think we are seeing some good progress. And with those tools, TPI and Climate Action 100+, I think we have a bit of an element of nowhere to hide for the companies. So the pressure is on, and there is a lot more data for us available to assess companies. Thank you. Going back to Millie then.
Okay, ready.
Yeah, thank you very much. Just moving on to the final slide, which is our conclusion. This brings us to the end of our presentation. I'm just going to finish very briefly with a high-level summary of the next steps that Leicestershire Pension Fund sort of can consider moving forward, just to ensure that the fund is continually progressing its management of climate-related risks. And, you know, these are listed on the slide, so the fund can consider and is considering implementing a climate strategy, continuing to provide annual disclosures against the TCFD recommendations, continuing to implement the climate stewardship plan, and also updating its carbon risk metrics every year, and also using climate scenario analysis sort of every 2 to 3 years. So yes, just finally, I'd very much like to thank everyone for your attention. If there are any questions, we are more than happy to take them. So yes, thank you.
Thank you very much, Millie. I know, Keith, you have a question.
Thank you, Chair. Thank you for a very comprehensive report. I think we all agree that climate risk is very important, and the pension fund does need a climate risk plan or strategy. So I'd like to bring to your attention and ask a couple of questions. It's page 67 of my report and page 9 of your report. It's the recommendations progress and item number 1. It's basically develop a climate strategy, and by your own colour coding, there is room for improvement. So a couple of questions. First one is, what's being done to improve it? Secondly, you say you're going to conduct a review of the approach to managing climate risk in late 2021. We're now nearly at the end of November, which is late 2021. Okay, have you started that work, and when's it due to finish? And then you say, with a view to drafting a climate strategy in 2022. When in 2022?
I'll just add a couple of comments before I hand over to Bilesh. But regarding question 1, about why it's only at 25% status, this is because the recommendation is to have a climate strategy in place. It's not in place at the moment, so we can't mark it as fully completed. The reason it's at 25% is because the fund has indicated its intention to publish this, so it is coming. It's just not there yet. In terms of sort of the next steps for the fund's development of this, we will be working with Bilesh to do this. So in terms of timelines, I'll hand over to him.
We haven't set a timeline yet, but I suspect we will be expected to return something in the first half of next year. I'd welcome any comments on that.
Please do.
Yeah, I'm being a critical friend here, but I think that the plan and the strategy is critical. It's the main pillars. It's the support for climate risk management. And if we haven't got a plan and strategy in place and you can't give me a timetable for it, that does concern me somewhat. OK, and I would like more information, please, and to have a better understanding of when you're going to bring that plan back to us, the strategy. I know you've mentioned mid-year and all the rest of it, but I don't think we can wait that long. Can we not get it done sooner?
No, it's a fair comment. I suppose the thing to bear in mind, we do have a responsible investment kind of improvement plan, so there is work going on to improve what we do anyway. It was just having a bit more of an all-encompassing strategy to pull everything together. So no, it's a fair point. The reason we struggle a little bit on timelines is once you produce it, you have to go out to consultation and the rest of it, so it does take a little bit of time. The other element as well is working with Central, because obviously they're key to sort of where our investments go and how they get managed, and it's coordinating across the other sort of partner funds as well. So I know it's a bit flaky, but if we commit to coming back to you with a plan after we've talked to Central and give you something a little bit more concrete. But just to give you that assurance, work is still going on. It's just not all pulled together in one place.
Thank you. And I will be monitoring this quite closely. I think it's really important that we have a plan and a strategy in place. Thank you.
Thanks, Keith. So I have Adam, if you'd like to come in.
Yeah, thank you. First, I really welcome the challenge that was just set down under the previous question. That sense of urgency, I think that we should all welcome, and that increased sense of urgency. My first question is around how long we have had a policy of engagement, because we have hit many milestones, several COP conferences, IPCC reports. How has our engagement policy been adapted along those lines and in response to changes in the science and changes in the political arena? I think I really see the strong rationale for both divestment and for the engagement, the kind of policies or opportunities there, and I see there is strong rationale for both. But I do feel we're only getting one half of the coin in the presentations that we have, because members may or may not be aware that divestment is happening in other pension funds. Other pension funds are taking a different route. ABP in the Netherlands last month, one of Europe's biggest pension funds, chose to go down the divestment line. Waltham Forest, Islington, Lambeth, Cardiff and Vale, others have either or are looking to go down the divestment route. What I'm asking for, I guess, is in the formulation of a climate strategy, is that there is some desk-based research as to the success or otherwise of those decisions that other funds have made, not so we can seek to copy or mimic, because we have to make our own decisions, but just so we do so with our eyes wide open, because I don't feel we've been given a full picture of what the opportunities are. We've been told that Central Fund doesn't like divestment, and that seems to be without any assessment of why that is, and I think that is a real concern. And I'd also like to know how we might be engaging with our members in the decision making over the climate strategy as well. What do members think? We know that the general public is moving much towards wanting to see a more climate resilient, climate adapted future. I'd like our members to have an opportunity to see a strategy before it's adopted. Thank you.
Thank you, Adam. Claire.
Thank you, Chair. Just a couple of observations and perhaps a question for Central as well. So across the LGPS space, as well as funds declaring that they have divested, I think there's a lot more that have actually declared that they will become net zero, and I think that's the often quoted Environment Agency, which is one of the leaders here, has declared to be net zero by 2050, 2045 at the latest. I think that does demonstrate that this is not easy to do this within a sort of broader investment context, and thinking about how the implications of the investment returns, and to do this in a very measured way. Those who have declared they become net zero have a year to publish their plans on how they will do that, and it's not necessarily on all asset classes as well. In the Institutional Investors Group on Climate Change allows you focuses you on 4 asset classes, at least initially, and obviously the equities is a big part of that. I think I'd emphasise that the other asset classes are much more difficult. So putting a plan in place is not going to be easy. So I would suggest you take your time on this, but you should expect Central to be coming forward. They are managing most of your assets at the moment. So a question for Central really, what are your plans? There are a number of pools of LGPS money in the UK that have already declared a net zero plan. What's your timetable?
Thank you, Claire. Good points. Patrick.
Yeah, could we just come back on the net zero point? I agree with you. I think net zero is the strategy that has been adopted by most of the pools, and I think with divestment plans, you'd have to be careful to read between the lines as to what exactly is in the detail. So some of the divestment policies that we've seen have been limited to certain funds or asset classes, or they've been focused on divesting from pure play coal or tar sands. So they're not comprehensive fossil fuel divestment policies by any stretch of the imagination. On net zero, this is, we're working very hard to get a position on net zero that is compatible and consistent with all of our partner funds' ambitions in this space. And I can tell you now, it's certainly our determination and conviction to announce our own net zero position as soon as possible. Now that hopefully will happen early next year. I would imagine that will come out. And as you say, a more detailed implementation plan will follow. But we've tried to avoid making a declaration without really understanding what the implications are and how we could go about delivering it. And that's really been quite a big focus of some of our work this year, is looking at the IIGCC framework, but other framework documents and the implementation strategies that have been announced by other asset owners.
Okay, thank you very much, Patrick. That clarifies. Meloise.
Basically questions about the carbon risk matrix. I imagine that each company is independently audited and not figures issued by them. And I wonder how they use carbon capture schemes to offset their carbon emissions. Would you help me on that, please?
Yeah, so it's a good question because it does vary. Some companies do use external auditors to audit their climate numbers, others less so. And it's very topical, actually. There's been a report done by an academic at UCD into the numbers reported, comparing the total number reported to disaggregated numbers that the company also reports for different business units and regions. And it's been found that they often don't add up. So there are some real issues around carbon reporting, and we're part of a collaborative engagement with the Church of England and Brunel, which is the pool for the Environment Agency, to discuss with companies how they can become more comprehensive and accurate in their reporting of carbon emissions. Because quite frankly, if we don't get accurate data, the whole measurement of net zero and decarbonisation becomes a bit of a farce, and we're in real trouble. So again, it's another example of where engagement can bring about real important change and improvement in transparency and disclosure, and that will help all of the analysis and reporting that's done around climate risk and carbon risk for the whole of the investment community if we get better data. And then on your second point, could you just remember the second point?
Well, it's really, I know
yes.
various polluting firms are planting trees and saying, well, this is carbon capture, and therefore they offset it against their targets.
Yes, absolutely. And in the numbers that Millie analyses in the climate risk report, there's no offsetting in there, in those numbers. But when companies declare a net zero plan, I think for certain sectors, there's an inevitability that they will need to use offsets to offset their residual emissions that they can't decarbonise anymore against planting trees. And there are other technologies that may be utilised for that. And again, that's another very important area for investors to really kick the tyres hard on the accounting that companies are doing around this, because there's quite a few problems with offsetting, and it would be quite easy for those numbers to be inaccurate. So if we get inaccurate carbon numbers and then inaccurate offsetting numbers, who knows what the real world situation is. So again, it's another area for shareholders to act as owners of these companies and demand the highest standards possible in this disclosure.
Thank you very much, and thank you all for a very in-depth analysis of what we are doing, and there's no doubt about it, more needs to be done and will be done, and I thank members for their input. Now, we are asked to approve the recommendations as set out within the 2021 Climate Risk Report and paragraph 4 for the recommendations. Is that agreed? Everybody's agreed now. Thank you. Now, I'm going to, we have spent quite a lot of time on the last item. I'm going to move to item 11. I'm going to take items 11 and 12 next. So that is the item 11 is the Pension Fund Annual Report and Accounts. And I'm going to ask Declan to present this.
Thank you, Chair. This agenda item just covers two areas, really. One is the external auditor's opinions on the accounts, and the second is the fund's annual report, which kind of comes to the committee once a year. And the reason they're taken together is because the accounts form part of the overall annual report, and the auditor does look at the annual report for consistency to the accounts as well. So I'll just pick up the audit first. It's actually still ongoing, as common with most sort of audits have been delayed for the last couple of years, and this year sort of is as bad as sort of last year in truth. So they have indicated, it's down in page 275 if you've delved that far into their kind of interim findings. And as of it yesterday, they're still expecting to give the fund's accounts an unqualified opinion, which is the desired outcome. I know it sounds a little bit odd. They did highlight, and again, it's on that paper in the pack, one adjustment required, and this is basically an estimate of evaluation of some private equity that we had to make it sort of for us at March, but by the time the accounts were, for the time of the accounts being drafted, but by the time the audit had come, those estimates had been updated, had been replaced with actual figures, and on the good side, the investments have performed far in excess of what we expected. On the bad side, it meant that they've gone so far it had broken the materiality level, so we have to sort of update the account. So it's kind of we use the same technique as previous years. It's just that technique was, I don't know, was kind of not good enough, I suppose. So we'll have a look at that next year, but it's not a particular concern. What's not covered in the report is the external auditors do also look at the contents of the annual report, and unfortunately, kind of although the numbers were consistent to the account, they did identify some areas missing from the sort of latest SIPFA guidance, and that's what Cat's kind of just sort of handed out. Unfortunately, it was an oversight, and I do apologise for this to the committee. We did just miss the latest guidance, and it continued with the years before. So the paper just outlined kind of half a dozen areas where we've missed. And the proposal is to update the annual report before it goes to the annual general meeting with 5 of these areas, just kind of close those gaps. Unfortunately, we only found out on Tuesday, so we weren't able to adjust the report in time for this committee. The area that we aren't proposing to change is a value for money statement. It's just basically it's a new requirement, and it's just the time taken to do it. So we're going to have a look at that and try and obviously crib other people's as well, which we haven't been able to find any published ones yet. But it's not an area that's going to delay the external auditor's opinion, because they're primarily concerned with the consistency of numbers. But it's just something they sort of have to draw to the committee's attention. So I don't intend to go through the report, but have to take any questions either on the corrections or the content of the report itself.
Thank you, Declan. Have any members got any questions on the report? It's fairly clear, straightforward. No. We are asked to note the progress report provided by the external auditors, which anticipates issuing an unqualified opinion on the pension fund accounts. We're also asked to note that the Corporate Governance Committee will receive the external audit of the 2020-2021 Leicestershire County Council Statement of Accounts, Annual Governance Statement and Pension Funds on the 3rd of December 2021. We are then asked to approve the Pension Fund's annual report and accounts, subject to the inclusion of the small number of additional disclosures required by the new SIPFA guidance, as discussed by Declan. Is that agreed? Well, that's unanimous. So we now move on to item 12. This is the Risk Management Internal Control Reports. Going to ask Chris Tambini, Director of Corporate Resources, to introduce this item.
Thank you, Chair. I am conscious that there's got more agenda items to go through, so I'll be very brief. It is the usual risk report. There's a couple of changes. One new risk around identifying kind of the death of scheme members that result in an overpayment. You don't do it quickly enough, and also a little uptick in terms of the Mcleod risk to do with system issues. The details in the report, and I'm happy to answer any questions on it.
Okay, thank you. I mean, as Chris has said, the detail is in the report. Have we got any questions? No, right. We have no questions on that. So we are asked to approve the risk register, the revised risk register. Is that agreed? Everybody agree that? Thank you. So we're going to move back now to item number 8, which is the LGPS Central Emerging Markets Equity and Global Equity Fund update. Bulesh will introduce this item. We are joined by Mark Davies from LGPS Central, who will present on this item. So over to you, Bulesh.
Thank you, Chair. A lot of what's included in this short cover paper is also included by Mark, so I won't go through it too much. I know we're short on time, but very quickly, Mark's going to cover off 2 active equity products: the Emerging Market Equity Fund and the Global Equity Fund. These are both active, like I say. The point here being that active managers should be able to find opportunities. They pick the underlying shares. They don't have to follow a passive mandate. In return, they charge us a little bit more, which makes it important that they outperform the benchmark. Point 4 on the paper shows their outperformance target. So the Global Equity Fund needs to outperform the benchmark by 1.5% over a rolling 5-year period, and the Emerging Market Equity Fund needs to outperform the benchmark by 2% over a rolling 5-year period. We do have a significant amount of money in both of these funds, so combined about 700 million at last count. That's about 13% of fund assets. One of the funds is performing roughly in line with the target and the benchmark. The emerging market slightly behind. It's probably a good time there to hand over to Mark to talk through those two and where he sees those two heading. Thank you.
Thanks, Bulesh, and thank you very much for your time. For those of you that I've not met previously, my name is Mark Davies and I am the Investment Director for the Active Equities at LGPS Central. I've been asked to keep this a bit brief in the interest of time. The first slide that I was going to talk through was slide number 4 in my pack. I don't know, it is the market outlook. Equity markets looking forward will all be about the reopening and recovery trade, or I wrote that last week. After Jay Powell was renominated, he's a lot more hawkish of a Fed chairman. So there was forecasts that there'll be 3 interest rate increases. This would be good for the cyclical stocks and the recovery. you would see the growth stocks start to unwind as their discount rates increase. However, overnight, obviously, there's been news about a new Delta variant, and equity markets are now are concerned and have actually sold off quite significantly this morning. I think this shows the level of volatility and uncertainty in the markets at the moment. Markets and active equity managers in particular, they like stability, they like normalizations, and we're very much not in that type of environment. So as we see today, markets are still being driven by the COVID news flow, really, and we'll continue for some time. So moving on to slide 6, just as a highlight, as Balesh said, the Global Equity Fund is active. We delegate responsibility, day-to-day responsibility, to 3 fund managers. As a reminder, those are Harris, Schroders and Union, and they have a performance target to outperform the FTSE All World Index, which is kind of a representative index of all global markets, by 1.5% per annum over a 5-year period. Now that is slightly longer than kind of like normal performance targets, but that's reflecting the nature that the clients are pension funds and should be looking for a longer term return horizon rather than short term performance pickup. So on to slide 7. Here you can see the performance of the fund since inception and over various time periods. As Balesh mentioned, it is ahead of benchmark, slightly behind that performance target, but we are only 2.5 years into that 5 years, so there is time. And just you can see kind of on that table on the bottom left that in a measurement against all our peers and the wider industry using a system called Divestment, the fund actually is in the second quartile over 3 years and 5 years, and first quartile over 1 year. So something we're very proud of. I'll skip slide 8 because that just covers the managers that we use and their individual performance, and it's the previous slide shows you how they all combine together. Slide 9 as well talks about where that performance has come from, and to give you a bit more kind of like colour for what the fund holds, I'll just talk through some of the top 10 holdings in this global fund, and it's by no way it's quite I'd say focused around those larger caps to begin with. You know, the top 10 holdings are names you would clearly recognise. You've got Google, Microsoft, Amazon, JP Morgan Bank and Berkshire Hathaway. There are a couple of names that you won't really see that we don't own. One of them being Tesla. No, none of the 3 fund managers own Tesla. So again, in the kind of the performance headwind that Tesla has produced for our managers, again, it's fantastic performance. And we have a slight position in Apple, but in the grand scheme of things, when it's one of the biggest companies in the world, we actually are underweight Apple. On to slide 10, that's just the risk within the portfolio. You can see there from those bar charts at the top, it's kind of like the factors we're exposed to. We're pretty neutral on value, quality and growth. They're not statistically significant at the moment because of where markets are. And then, but if you look towards the right hand side, you can see the kind of like the ESG factor exposures. And just to highlight the final column, the carbon column is below the line. That actually means that we have a carbon footprint below the benchmark, subject you've obviously heard a lot about recently. Slide 11 is just what we've been discussing with the managers over the quarter. And just to pull out a couple of items there. We have been talking to all our managers about their ESG and their climate risk reporting, etc. I'll go on to that further, but we've been listening to one of the managers around their positioning in the energy sector. And just to remind you, the energy sector is the best performing sector year to date. It's up some 40%. That does include renewable energies, but it has been the oil and gas companies that have driven those returns. We've been talking to them, though, around their adoption of the climate risk in their own models, and they're very much focused on those companies that are transitioning. It's what their research is showing to be. So companies like Equinor. So then on to the next slide, 12. This is where the global equity fund sits. So there's a range of carbon footprints by our managers. So again, they have responsibility to manage that risk, but they're all below the benchmark using the modelling that you've heard about that the team undertake. It's worth highlighting that one manager, and this is our value manager, has a position in fossil fuels, and it's driven by their two high conviction ideas. You've heard about engagement ongoing with one of them, and the other one being a large conglomerate that does actually have a power generation business. And we engage with our managers around that and what they're doing in that space. And then again, you've also heard actually the largest contributor to that, the fund's carbon footprint, is again another example that you've just heard, Next Zero Energy. On the net zero alignments, we've heard that there's questions around that. What I'd say is that 2 of our 3 managers have already signed up to the net zero initiative that I think Claire asked about, that being Schroders and Union. Schroders were one of the initial signatories. Union have recently signed it, so they, as Claire mentioned, they have a year to deliver their part, how they're going to achieve net zero. The other fund, Harris, is an American-based fund manager. They seem to be a bit behind development, American asset managers in general, behind Europeans in this space, but they are working with us. They are a manager to some of the other pools, so they're being engaged by Brunel and Environment Agency, etc., around developing in this space. And they recently introduced a report that it shows that their portfolio is actually in line with a 1.5 degree transition. And then the next 2 slides I'll skip through. They're just engagement and stewardship reporting, but you've heard from, again, my colleague Valborg around how that's undertaken. So on to the emerging market fund. It's a similar setup. It's 3 fund management groups that we delegate down to. This has a higher return target though, because it's a riskier area in the world. So this is 2% above the emerging market index over 5 years. And those 3 managers are BMO, who have recently been taken over by Columbia Threadneedle, UBS and Vontobel. So again, this is only just over 2 years old into that 5 years. Performance here is actually below benchmark. It's something we're working on and working with the managers to improve that performance over the short term. If we flick forward to slide 20, again, here's some the performance numbers of what's been driving that performance, but to give you some indication of kind of like the big positions that we hold. The top holders are Tencent, which is a Chinese gaming company, Taiwan Semiconductors, which makes all the chips that go into your mobile phones, your cars, everything really in the world, HDFC, an Indian bank, and Infosys, a Indian data consultancy business. Right. And again, so just some background into the emerging markets, that actually 40% of emerging markets is China. So it's been very volatile of late with this year with the Chinese regulation clampdown in certain areas, which has caused some of our managers to underperform due to their positioning their overweight positioning in China. Again, the skyline there on slide 21 shows that we are a quality growth focused fund in this area with a strong ESG tilt. And again, that carbon footprint is below the benchmark. As I've mentioned on slide 22 already, a lot of the conversations we've held this year with our managers has been their position in China and their thoughts on responsible investing in this space. For example, one of them takes a very different view. BMO has a clear focus that it doesn't like to invest in some of the shareholder structures that you see in China, and they use that as a screening tool as part of their process. Again, no manager, all managers have a carbon footprint or intensity below the benchmark. No manager has any fossil fuels reserves above the benchmark. And no manager has exposure to any coal power generation. Again, these are active stock pickers. It's it's their choice. They weigh up the risk and reward, and obviously they see that the risks outweigh the reward. They can naturally, if they see the risk increasing, they naturally can sell the stocks. They don't need to hold everything. So again, just on to make it clear on the net zero position, again, 2 of these managers have signed up to that asset managers initiative to be reach zero emissions by 2050 or sooner on all assets under management. That being BMO and UBS. The other manager is Vontobel, and they are currently assessing the initiative and whether to become a signatory. But it's something we keep communicating with them on. And to highlight the importance that this brings is actually when we talk to our managers, Patrick, Millie and his team actually join us on those calls as well to drive home the view, what we hear from yourselves and other partner funds in this space. And with that, I'll happily open to any questions. Stop talk.
So, members, have you got any questions? Malise, you have a question.
I've got 2, Mr. Chairman. Number 12 on slide 12. The largest contributor to the fund's carbon footprint is the world's largest public generator of renewable energy.
Yeah.
Could you just explain that to me?
I think you've heard about them. It's NextEra Energy. So they have a legacy asset. I guess it's that transition. They have, they're the world's biggest producer of renewable energy, wind turbine, solar panel, but they also have the utilities business and the legacy assets that I think that Valborg discussed. So,
so are they offsetting one against the other?
No, you can't really offset. Sorry.
Patrick, just use the microphone.
Yes, so you can't really offset in that way the emissions that you would. You can report that you're displacing emissions from fossil fuels by renewable energy production, but you can't offset in that way because you're not actually taking any out of the atmosphere by doing that. And as Mark says, he's absolutely right. They're a company in transition, so they do have a very big renewables business, but they do still generate some electricity from coal. They're an American company. And, you know, again, you could ask the question about divestment. Is that a company that you would divest from, even though they're the world's biggest generator of electricity from renewables? They're still quite carbon intensive because of the legacy business. And same with Glencore. They get, about 4% of their revenue from coal, but they also have this exposure to cobalt, nickel, and copper, which all have some upside to the transition to a low carbon economy through batteries and wind power and things like that. So it's just pulling out some of the nuance there, I think.
Can I ask a question? What does Central do when you see underlying managers in either global equity or emerging equity markets taking positions in carbon intensive companies such as cement producers?
So they have full delegated responsibility to make those investment decisions in line with the mandate. At the moment, there is no carbon targets after that mandate. What our role is to assess that they are taking on climate risk in that analysis. So when we see that them buying cement manufacturers, for example, which has been the key driver in the emerging market portfolio increase, we have monthly and quarterly calls with those managers. The team from the RI team, we're there to help with the fundamental analysis and improve our kind of understanding about climate risk. But the team here also come on and question them on the finer details and the bigger mega trends around those kind of like cement in general. And we challenge them on whether they are understanding that risk properly within their assumptions, and for us to become comfortable with them and just, you know, kind of like shine a spotlight on those particular holdings.
So I just have one question myself. If individual managers' climate change policies are included in the pack, can you summarise how they are aligned to Paris net zero, and which managers are the laggard, if any, and what are the LGPS Central going to do to address the matter?
So of the strategies that Mark just defined there, there's no targets or parameters around carbon emissions. What we absolutely demand is that they integrate ESG considerations into their investment process. And as Mark said, when they do have investments in fossil fuel companies or some exposure to a high carbon intensive company, they have to demonstrate how they got comfortable with that holding and how that got through their ESG process. So we don't measure at the moment their Paris alignment. We measure their carbon intensity compared to the benchmark, and that's the measure that we discuss with them, and that's our measurement of risk. When we do go down the route of declaring a net zero ambition, that will obviously be delivered by our external managers, and that's when the conversation would move to Paris alignment or net zero.
Thank you very much. Thank you, Patrick. Have we got any other questions? No, there are no other questions. So, committee, we are asked to note the report and presentation. Is that agreed? Yep. Thank you. So, on to item number 9, summary evaluation of the pension fund investments. Declan Keegan, Assistant Director for Finance and Strategic Property, will introduce this item. Over to you, Declan.
Thank you, Chair. I'll just give a quick introduction to the report. I won't go into the detail. Just pick out a couple of bits. The Hyman's Capital Market update has been included for the first time. It's just try and give committee a bit more sort of easily digestible kind of sort of overview of what's going on. So there's a summary in the report, but actually the main report's in the appendix. It's quite worth having a look at it. It's kind of quite easy to follow. I mean, as you'd expect, it's been touched on a couple of times already. Inflation is the kind of dominant narrative in there, but as with anything else, you know, markets just seem to be shrugging everything off at the moment, and they seem to be doing the same with inflation. So it's not giving you any great insights, but it's a worthwhile read. The next couple of sections of the report just cover the changes to the portfolio, but these are pretty much just going on as intended and what we've been kind of what we trail with the committee. And as you go down to sort of paragraph like 19, it just picks up the changes we still need to make to the strategic asset allocation. They're very much in sort of the queue of sort of stuff, sort of central developing products, and sort of we're in line to sort of invest in those. So that's likely to be next year before anything sort of fundamental happens on those. So don't expect too much sort of for the rest of the calendar year. When you get down to sort of the performance section of the report, you'll see sort of paragraph 20 onwards, you'll see sort of the table in paragraph 23 just picks up where we've had a very good quarter, and that's kind of nudged all that kind of performance against benchmark across all the time periods reported on, which is obviously positive. I won't go through any more of the detail. We've heard quite a bit from sort of Mark about the sort of two main central ones, but happy to take any questions.
So, have we got any questions from members? We have not. We haven't. No. Okay. So we asked to note the report. Is that agreed? Thank you. So the next item is the Local Pension Board annual report. Mrs. Page, Chairman of the Local Pension Board, will introduce this item. Is Mrs. Page online?
Yes.
So over to you, please, Rosita.
Thank you, Chair, and good morning, everybody. I'm very pleased to present the Local Pension Board's annual report for 2021, which sums up very much a busy and varied year for our board. As you will be aware, our role is to assist the administering authority to secure compliance with regulations and legislations, as well as to ensure the effective and efficient governance of the fund. Throughout the year, we have scrutinised the fund, and we have no concerns whatsoever to raise on the fund itself or its administration. But I would like to take this opportunity to briefly highlight some key points. Throughout the year, we monitored employers' risk, including bond values and contract dates. As part of this year, we wrote to some of the employers expressing our concern that they had not yet completed a bond or admission agreement as part of their 2P. Hang on 1 minute, I'm losing my minutes and my notes. We are pleased that these were finally completed in February this year. However, it is clear that the area of employer risk and governance will continue to grow for the pension section, and the required resource will need to be allocated accordingly, which we will monitor continually. We also continued to consider the potential impact of the Mcleod Judgment, which, as you know, found when public services pension schemes changed in 2014 and 2015. They had discriminated on the grounds of age by only providing protection for older members. It is clear that government's intention is to fix unlawful discrimination in the public service pension scheme, but we await any impact it may have, as we expect a major strain on the pensions team resource with the requirement to recalculate members' benefit and potentially to re-aggregate cases. Additional, as I seen in my attendance at previous committee meetings, it's clear the fund has an enhanced focus on climate change. While we don't oversee the investment side of the fund, we are pleased to receive an update on the fund's annual RI plan and trust the committee will continue to do these duties. Before the end of the year, we consider the Prudential, the fund's additional voluntary contribution, AVC provider. Following concerns raised by the pension manager that they were breaching service standards, we will look to monitor the service that they provide, and since year end, we have met with them to answer for the service provided and understand that mitigation would be put in place to avoid such issues in future. This was a very big issue to us, actually. It is a significant concern to the board that the problems would impact on members' ability to receive payment of the pension benefits in a timely manner. Looking forward to next year, we will await further guidance from the Scheme Advisory Board's Good Governance project with regard to the final recommendations to be implemented. Though we are pleased that in the meantime, following the year end, the committee had approved a conflict of interest policy and enhanced its governance statement found within the fund's annual report, which is also on today's agenda. I will conclude by expressing my thanks to my fellow board members, officers, and all their contributions to our meetings, and of course to all of you. I recommend my report to you, and thank you very much, everybody.
Thank you very much, Rosita. Do members have any questions or comments to make? No, there aren't. Claire, if you would ask your question or come make a comment.
Thank you, Chair. I think this is relating to the kind of forward plan and activity for the board going forward. I would maybe just highlight that the Pensions Regulator Code for public sector schemes, which is currently called 14, that's going to be replaced by a much broader, longer code. And I would just recommend that that is on the board's radar, as well as the committee as well. I'm sure, hopefully it is, and I'm sure it is, but it's not specifically mentioned in the report.
Thank you, Claire. So thank you, Rosita, for attending and presenting the board's annual report to us this morning. Much appreciated. Thank you. So the next item we're on to is item 13, update on the LGPS Central Joint Committee and Annual General Meeting. So Bulesh, if you would introduce this item.
So we've had since the last update on it. We've had 2 meetings. We've had a joint committee meeting on the 18th of June. There were a number of actions agreed, which are listed in point 13 A, B, C, and D. None of which were of any real large importance. There was an AGM on the 28th of September also. It was a virtual meeting, and all the resolutions proposed by the company were approved. That included the re-election of directors, adoption of the company report and accounts for the year ended March 21, and approval of remuneration packages for the chair and directors. There were a couple of items which were noted, which are listed in point 16, A and B. Shareholders requested that board subcommittee updates were to be considered as written rather than oral in the future, and the board asked that consideration is given to revive a number of working groups to improve and progress client and shareholder company goals. Any questions?
Thank you, Bulesh. There doesn't appear to be any questions, so we're asked to note this report. Is that agreed? Yeah, everybody agrees that. Yeah, that's. The action agreed by the investment subcommittee, I propose to take this one as read. Are we happy with that report? Yep, everybody, so we're noting it. Thank you very much. Right, so we're now on to, before we go to exclude the press and public, I'd like to remind members that the next meeting of the committee will be held on the 21st of January 2021, and the fund's annual general meeting will take place on Monday the 13th of December, which members are welcome to attend. I would also like members to be aware that the next meeting of the LGPS Central Joint Committee meeting will take place on Friday the 14th of January, and more information can be found on Cheshire Pension Fund's website. So, having got that out of the way, I move that in accordance with the Local Government Act 1972, the public be excluded from the meeting for the remaining of the items of business on the grounds that they will involve the likely disclosure of exempt information. Right, so now